Welcome back to book club. Excuse the backyard noise. I don't know why this maintenance guy felt the need to show up at 7 o'clock in the morning. Overachiever. Okay, so welcome back to book club. We're going to jump into setting the tone, the opening price for chapter 6, part 2, building indicators from the ground up, and reading basic bars, how to pounce on opportunities. All right, so again, excuse the background noise. There's some backyard maintenance being done probably for the next whatever. All right, so setting the tone, the opening price. The opening price is the first trade done between a buyer and a seller on the trading day. It reflects the new day's hopes and fears. The meaning of the open, like all price bar components, comes from its relationship to other components of the bars as they develop and to the components of the bars that came before, especially yesterday's close. The opening price may reflect factors other than sentiment about the security. Some decisions are arbitrary and random. Maybe Aunt Henrietta got up this morning and decided to sell Blue Widget shares at the open to raise money to buy a racehorse. Also, fund managers may buy or sell at the open to rebalance their portfolios to reflect new money in or out the day before. And US equities, the open often isn't actually the first trade of the day, but a synthetic price like an average of the first 5 trades, devised by the exchange or the data collector. This is why the opening price varies from one source to another. Not having accurate data drives some technical analysts nuts because the opening price sets the tone, and if somebody made it up, it doesn't matter how reasonable the calculation process, it's not literally the first price of the day. This problem is now compounded by the existence of several exchanges trading the same securities and related options. Some equity analysts say that they ignore the open because it's not accurate, and although in futures trading the open is the real McCoy, in many instances, such as equity index futures and foreign exchange, trading has been going on in overnight markets, so every time zone has opened. In other words, the actual open on a US exchange may not be the written in stone benchmark you may think it is. So, should you heed the open? Yes, in equities. Any particular opening price may not be accurate, but over a series of days, the open adequately represents the sentiment at the beginning of the day and serves as a benchmark for evaluating the upcoming price action over the course of the day. And the placement of the open relative to the close the day before and the close today are 2 of the criteria for judging whether a security is trending. The opening price's most important relationship is the close of the day before. When the open is up, if the open is higher than the previous close, you deduce that the first trader of the day spotted fresh news favorable to the security, is expecting favorable news, or has some other reason to think his purchase will return a gain. If you too see a price rise coming, his action reinforces your analysis. The first trade sets the tone. When the open is down, if the opening price is below the close of the day before, look out. Maybe bad news came out after the close last night. The bad news may pertain to a political event, a change in interest rates, a bankruptcy in the same industry, or a dozen other factors. Summarizing sentiment, the closing price. The closing price is literally the last price at which a buyer bought and a seller sold before the closing bell. The close is the most important part of the price bar. If you were to draw a chart by using only one of the bar components, you'd pick the close. A series of closes over a small number of days is an indicator in its own right. The close remains the most important price bar component despite after the bell trading. When you see a line chart at websites, including Yahoo Finance or the Wall Street Journal, the line is comprised of a series of closes. Every site has a little icon, usually on the upper right, where you can convert the line to standard bars or candlesticks. The close is the most important component because it summarizes traders' sentiment. The traders have watched this price all day, and by the end of the day, they have a sense of how popular it was near the lows, lots of buying going on, or how unpopular near the highs, lots of selling going on. They're also looking at volume to confirm these impressions. As the close approaches, traders have to decide whether to hold the security overnight, something they will do only if they think it's going up further overnight and tomorrow. Note, also the close is what brokers use to value your portfolio at the end of an accounting period, named mark to market. Say it's year end and you're holding 100 shares of Blue Widget. You want to know what it's worth. You'd apply the close on December 31st to get a mark to market value. Mark to market is always hypothetical. The closing price on December 31st isn't available for an actual transaction until January 2nd. Professionals whose job performance and bonuses depend on end of period accounting care passionately about the close and will sometimes engineer a higher close in the last few minutes of trading to make their mark-to-market positions look as valuable as possible. After-hours trading creates a problem in evaluating the close. How do you treat the close when your security makes a new high or a new low in after-hours trading, only 10 minutes after the close? The answer is that you don't adjust the close. In terms of managing your data, the open and close are associated with the trading hours of the primary exchange where the security is listed, like the New York Stock Exchange or the Chicago Mercantile Exchange. No matter how the security trades after the official close, the new information is included in the price data for the next day. This can result in some peculiar outcomes, such as the price opening at $5 and closing at 7 on the primary exchange during regular hours, but both the high and the low occurring in after-hours trading and reaching, say, $4 at the low and $9 at the high. The new high and low gets incorporated in the next day's data. As with all price bar components, what's important is the relationship of the close to the other bar components, especially the open today and the close yesterday. Over time, the cumulative relationship of the close to the close the day before gives you a good impression of directional bias. When the close is up, if today's close is consistently higher than yesterday's close, day after day, buyers are demanding more and more of the security and are willing to pay an even higher price to get it. In other words, the close is up. The close is up. Figure 6-2, with the exception of day 4, every close is higher than on the day before. If you see a trend like the one shown in figure 6-2, you may want to join the crowd and buy into the trend when the close is down. So when the close is down, in figure 6-3, you can see that day 3 starts a series in which each close is lower than the day before. Here, the sellers are willing to take ever lower prices to get rid of the security. You can assume that those holding an inventory are willing to sell at lower and lower prices to prod buyers to demand it. Just like the car dealer puts last year's cars on sale before the new models arrive. When you see a down move like the one in figure 6-3, you may want to join the crowd and be a seller. Hope, fear, and risk management at the close. On an up day, you hear that today the bulls won, or on a down day, today the bears won, acknowledging the emotional aspect of trading. Bulls hope for a profit or greed, and bears fear a loss. But emotion may have nothing to do with it. Traders also make buy-sell decisions to manage risk. Just as some traders buy on the open as a standard practice, some traders sell on the close, chiefly to eliminate the risk of loss if something happens overnight, to push the price down. Institutions as well as individuals use the simple risk management tactic. Should you? Yes, if you fear the market could gap over your stop. Because so many people exit on the close is seldom the high of the day. And when the close is at the exact high of the day, that's useful information. It means people who do hold overnight positions are buying right up until the last minute, offsetting the usual end of day sells. This is a strongly bullish signal. Going up, the high. The high of the price bar is literally the highest point of the bar. It's the highest price at which a buyer and seller made an exchange of cash for the security. The buyer thinks the price will rise some more. The seller holds the opposite view, that the price will likely fall. The high of the day has meaning only in the context of its relationship to other parts of the same bar, especially the close and to the high of the day before. Current events: buy on the rumor, sell on the news. New highs and lows are often the seed of a new trend and usually arise directly from a specific piece of news. Fresh news that causes a new high or a new low is an event. The risk that a new high or low will ensue from the news is an event risk. It may seem odd, but most events aren't surprises, but rather scheduled, such as news or a rumor about the security, such as a company's earnings announcement, market-related events, such as options expiration dates or tax and calendar period dates, scheduled releases, such as the Fed's interest rate statement or any of a dozen economic reports. Event risk also refers to unexpected developments, acts of terrorism and war, natural disasters, correlation of a stock to the performance of the major indices. Even if your stock is doing well, for example, it can open down from the close the night before as a side effect of a drop in the index or sector to which it belongs. Previous technical levels, such as a round number or a historic high or low, see Chapter 4. Traders treat forecasts prepared by economists and analysts as though the event had already happened precisely as predicted. In other words, they build in the forecast to the price, creating the very high on the price bar that the news is supposed to produce. This practice is named buy on the rumor, where rumor refers to the forecast. The rest of the phrase is sell on the news. The news is the event itself. You sometimes get the seeming paradox of a price reaching a new high before the event and falling immediately lower after the event. Even when the news matches the forecast, the lower prices arise from the early birds taking profit on the up move that they themselves engineered. The new low is usually short-lived when the forecast of good news was justified. If the news is much better than forecast, though, traders may not take profit because they know better than expected news draws in new players and sends the price higher still. Then the early birds are positioned to make even better profits. Should the news fail to match expectations, traders and investors alike sell, and the dip may turn into a longer-lasting price drop. Either way, to buy on the rumor pays off for the short-term trader who keeps his finger on the trigger. Still, evaluating forecasts and being mentally ready to buy or sell at the moment of impact of the news is a difficult and risky business. More risk-averse traders get out of the market altogether around scheduled event dates. Buy on the rumor, sell on the news is a primary cause of technical price developments, and in many instances, the only technical analysis that commentators mention, along with the 200-day moving average. Getting to the bottom of it, the low. The low of the day is the cheapest price at which the buyer and seller exchange cash for the security. The buyer thinks the price will rise, the seller believes the price is going to fall or is already falling. As with the high of the day, the low has meaning in the context of its relationship to other parts of the price bar and the bars that precede it. When the low is lower than the open, it probably means that some fresh news has come out after the opening bell that offsets any buy on open orders or initial sentiment. When the close is at the low, it means that bad news or negative sentiment ruled for the day. You can judge the power of fresh negative news by checking whether it inspired traders to produce not only a close at or near the low, but also a low that is lower than the low the day before. All right, we're gonna call it there. Thanks for joining. I'll see you next time.